Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 258th podcast VideoCast for the week ending September 26, 2024, live from New York. So first we'll do family stuff, then we'll get right down to business. This is from regarding Annabelle. Congratulations to Annabelle Hayes, Hayden, Yuen, Grace Wang, and Hope Human for breaking the Southern California state record in the 9 to 10 girls 200-yard medley relay with a 2.02.96. Way to go. That is a state record, ladies and gentlemen. So very, very excited for Annabelle and her team. This is my buddy Mike Bennett, who I've shared with you from one of the inventors of Stack and Tilt, just all around incredible guy. He's actually on the book, Stack and Tilt, and that's us playing Stanwich for the first time for me. I'm sure he's played it. What an incredible course. It's the number one or two course in Connecticut right now. This is an amazing story. We got paired with Tim Tuffle of the Tuffle Shuffle. For those of you who are New Yorkers and remember the world champion Mets in 1986, back when you had Doc Gooden, Darryl Strawberry, etc. That was Tim Tuffle, the second baseman, legend. Really enjoyed playing with him and his son, Sean Tuffle, who also was a professional baseball player, was a pitcher for like 4 or 5 years, and just an awesome guy and great, great time. That's at my track the night before. There's Annabelle at the swim meet. So we got a lot of pictures here. This is at the New York Stock Exchange this morning with Kristen Scholler of NYSE TV, and you can see some of the pictures. For those of you who have never been down there, it's such a special place. Wanted to get as much of the background as possible. That's the building itself right outside. That's the entrance where guests walk in that are going to be interviewed. This was a natural gas company ringing the bell today. That's where they ring the bell. And this is at Yahoo right afterwards. And this is the CNBC booth. That was David Faber and Sarah Eisen. This is the booth where they cut all the TV clips at Yahoo. Moving along. This is a picture of Mimi met Olympic gold medalist swimmer Michael Andrews and world's strongest man Mitchell the Moose Hooper. So I'll let you guess which one is Mitchell the Moose and which is the Olympic swimmer, but she's doing a great job out there with her training. And she's now rowing. This is her rowing, which is exciting. I'm excited to head out there tomorrow. We are going, well, after Fox, I'll be on the Clayman countdown at 3 o'clock, and then straight into a car to fly out. We're going to do full tilt, Disneyland, California Adventure, the whole tour, no line, exciting stuff, Club 33. So I'm super excited about that. And then I'll watch them play a few games on Sunday. And then I'll be back on Tuesday to do Fox Varney and Company, thanks to Christian Dagger and Preston Mizell for that. So tune in on Tuesday morning to Varney and Company. First thing here, we'll do the media. Want to thank Jeff Cohen and Kristen Scholler for having me on the New York Stock Exchange this morning, responding to the China stimulus, etc. We're going to listen in here.
What a celebration here at the New York Stock Exchange. BKV, a natural gas producer, opening its shares on the market to debut. It's going to be IPOing. We haven't seen that stock open just yet, but perhaps in just a bit of time after this opening bell. Joining me now to talk about what we see in the overall market is Thomas Hayes. He's a chair and managing member of Great Hill Capital. Thomas, always great to have you with me. And the market's so in focus today, especially after some of these stimulus measures out of China overnight. What can you tell us?
This is enormous news. This is a regime change. This is a game changer. the Chinese government finally released the stimulus bazooka that everyone has been waiting for. And if you look at it now, the green light is on. So you've got the U.S. trading at 22, 23 times for good growth. But in China, the growth is now going to start recovering, and you're trading at 8, 10 times for some of the biggest companies in the world, like Alibaba, the #1 cloud provider in Asia, like Tencent, like so many. So the market is very excited because if growth comes back in China, which it will, they said we're going to do whatever it takes. This is a big deal. That's going to be good for all the developed markets as well.
And certainly we see U.S. stocks opening higher today, still within those record high territories. The NASDAQ leading the way, the NASDAQ composite, that is, tech stocks, and certainly solid economic data. What we saw overnight in China with these stimulus measures, do you foresee an impact on U.S. stocks?
I do, in the long term, okay? So this stimulus, you're going to start to see growth come back in China. That's going to help U.S. companies. If you recall, companies like Nike have been down because of China worries. Estee Lauder has been down because of China's worries. Starbucks has been down because of China worries. So all these companies are going to benefit as that growth comes back. They're issuing $286 billion of bonds for fiscal stimulus. Everyone said, well, the monetary stimulus is great. We need fiscal. We need fiscal. They said, it's coming, and it will do as much as it takes. So all the multinationals are going to be big beneficiaries of this stimulus overnight. We're pretty excited about it.
Well, in terms of excitement, we see executives from BKV, this company set to IPO today here at the New York Stock Exchange, signing the wall after that celebratory opening bell podium. We'll be speaking with those executives, including the CEO, momentarily. I'd love to get your take, Thomas, as an investor with a wide aperture as to what you make of the natural gas space.
I love it. As you know, Kristen, for many years we've talked. I'm a contrarian. I like to buy what's out of favor, what's high quality value out of favor, and I think natural gas right now is an opportunity of a lifetime. It's trading in the doldrums. No one wants it, and the demand for energy is going up, and it's the cleanest energy that we have plentiful sources in the United States, unlimited amounts. So companies like this going public, we own a company called Comstock Resources, which Jerry Jones owns 71% of the equity. He's the owner of the Dallas Cowboys. So I think they're going to do well. I think Comstock's going to do well. We've got a little bit of Range Resources that we've owned for some time. That's up quite a bit. So this is the time to be buying China. This is the time to be buying natural gas, and I think their timing is perfect.
Okay, great. Well, I'm sure the executive might want to talk to you, Thomas, after this market open here, a strong market open that we see at the stock exchange. As we look to round out the third quarter, September, we see decent gains, record highs. Investor sentiment seems to be strong. Heading into the fourth quarter, we'll have a new factor like the election. What's the state of play right now for U.S. markets?
I think the Fed, with the front-loaded rate cut last week, cemented what we've been calling for a regime change for many months. So we're going to have a shift. You have to be selective. You can't just chase those Magnificent Seven anymore. Unmagnificent 493 is going to outperform Magnificent 7. Why? Because their earnings growth is accelerating while Magnificent 7 earnings growth is decelerating. Small caps outperform large caps in the first 12 months after a Fed cut by 11%. So you want to be small caps. Value outperforms growth in the first 6 months after the first Fed cut. So you want to have some value exposure. Everyone's crowded into defensives. They've been crowding into staples and utilities. We think discretionary is going to outperform. So the Nikes are going to come back. The Lulus are going to come back. The VF Corps are going to come back. And last but not least, actually most important, emerging markets is going to outperform developed markets. That's in part due to a weaker dollar. The dollar is going to trend lower in coming months and years. That helps emerging markets. The stimulus in China helps emerging markets. So all the places that have been left for dead, now it's Christmas time. It's opportunity to go shopping. So we're pretty excited.
Okay, opportunity to go shopping. I always like that reference here, Thomas. So when it comes to overall conditions, obviously that is key in the IPO market. Hopefully we'll see more of these international companies going public here at the stock exchange. What else do our viewers need to know, especially as they factor the election into their equation?
Yeah, I think this is a big thing because historically since 1955, you tend to get a lot of volatility in October ahead of the election. So U.S. stocks have run up a little bit, particularly the Magnificent 7, which is such a heavy weight. So you have to be careful. You have to be selective. If you're on margin, you might want to come off a margin. Don't be too aggressive. But we're staying fully invested. We'll ride out any bumps. And then I think after the election, once you get that certainty, doesn't really matter as much who's elected as president, so long as you have gridlock, not one party in the Senate, House, and president. As long as it's mixed, we're going to get a year-end rally after that. So be a little careful. The option skew, which is the cost to ensure 1 and 2 standard deviation corrections, just hit a 10-year record, which doesn't mean you automatically get a correction, but it just means be on alert for a little bit of volatility in October in case it shows up. So off a margin, stay invested, ride through the bumps, and I think by year-end you're going to be smiling so wide you could eat a banana sideways. So.
Thomas Hayes with Great Hill Capital. Thomas, thanks so much for joining. Great to get your take this morning. And let's take a...
And we're back. Then straight to Yahoo to be on with Brad Smith. Thanks to Noor Salim and Justin Oliver as well for having me on. More color on our current outlook.
To the markets and your investment portfolio. The S&P 500 hitting another intraday record high today after a couple data points signal that the economy is still on solid footing. But our next guest thinks that investors might want to prepare for a little bit of volatility ahead. To discuss, we've got Thomas Hayes, who is the Great Hill Capital LLC chairman and managing member here. Great to have you here in studio with us, Tom.
Great to be with you.
So let's discuss this. I mean, what type of volatility profile should people still be kind of keeping their portfolios ready for to weather as well?
Yeah, Brad, I think we had a regime change got locked in last week with the front-loaded 50 basis point cut. And what that implies is that the heaviest weights of the S&P 500, the Magnificent Seven, I think they're going to be a little bit choppy moving here. I think moving forward, history suggests that the unmagnificent 493 will outperform the Magnificent 7. That's because their earnings growth is accelerating while the Magnificent 7 is decelerating. History also suggests after the first rate cut, small caps will outperform large caps by over 11% in the first 12 months. So that's a big deal. Value outperforms growth in the first 6 months after the first cut. And as you probably noticed, everyone has been crowding into defensives ahead of the Fed cut. So I think you're going to see consumer discretionary start to outperform staples. Everyone's crowded into staples and utilities. I think that trade is up. And finally, this is the topic du jour today. Okay. Emerging markets will start to outperform developed markets after 10 years of not happening. The Chinese government overnight launched the bazooka. Everyone said, oh, the monetary cuts are pretty good, but we need fiscal. Well, they're issuing $286 billion of bonds. They're giving out money. Things are happening, and the green light is on. That's going to help not only emerging markets, it's going to help multinationals like Nike, that's been down, Lululemon, that's been down, Starbucks, that's been down on China fears.
Yeah, a huge stimulus effort that they're putting forward here and having more international impact here. You know, it's been interesting to get some perspectives on what quality looks like, what the characteristics of quality investment and people who are trying to put quality into their portfolio, what that looks like. What are some of those characteristics from your perspective as well, even as you think about the defensive plays that people can make or how you can make sure that your portfolio is able to weather any type of volatility right now?
Yeah, so you started with the kind of concerns about a little bit of choppiness into October. What made me a little bit on alert is the fact that skew, which is the cost or the implied volatility, the cost to insure 1 to 2 standard deviation corrections, think about 10% plus corrections, has actually skyrocketed to a decade high. That doesn't guarantee that you're going to have a correction right away. It just says it's time to be on alert because the smart money is taking out a lot of insurance. That differs from the VIX, which measures the cost of the at-the-money premium or insurance. So I think if you're on margin, you want to be off margin. We're fully invested. We're going to stay fully invested, ride out any bumps in October after the election clears, provided it's a gridlock outcome, regardless of who becomes president. I think we get a year-end rally, so you don't want to be stopping and starting. I just think it's time to be a little alert, particularly if you're a passive investor and you're overweight the Magnificent Seven, even if you don't know it.
For, it seems like months now, investors have had to hear about the broadening. When the Magnificent Seven and the successes seen in the Magnificent Seven it would broaden out to other earnings growth or earnings growth of the other 493 companies as well. Are we starting to see that? And if so, is it sustainable as we get into the back half of this year and earnings growth, regardless of the macroeconomic backdrop, comes into focus?
We are seeing it because you're seeing the equal weight index outperform the cap weighted of late. Okay. And this was an inflection quarter where the unmagnificent 493, as you referenced, broadening, just inflected and started to accelerate earnings growth. They had negative earnings growth in the second quarter. Yeah. So not only is it beginning, it's going to accelerate. Small cap earnings growth, 7% this year, 37% next year. So the game is on. It's exciting. It's a stock picker's market. And I'll tell you, the voodoo of China, there's some high quality companies. And to your point, how do you define quality? Is price is what you pay, value what you get. So we want to see a meaningful return on invested capital. That means the debt and equity that the company's taken in. What kind of return are they getting when they invest? We like double digits, low double digits, mid double digits. So there are companies over there. And we like to buy things that are out of favor. As you know, we've talked for many years. In the US, our best tech companies are trading at 23, 25 times. In China, their best companies are trading at 8 or 10 times, and they've got a ton of cash on their balance sheet. And with this stimulus, their economy is going to reaccelerate, and there's going to be huge opportunities, not just for US multinationals that are trading down because of China, but for actually some of the highest quality companies in China that have been left for dead.
That's really interesting. Tom, always a pleasure to grab some of your insights. Thanks so much for joining us in the studio here.
Thanks for having me, Brad.
Absolutely. Tom Hayes, Great Hill Capital, Chairman and Managing Member.
And we're back. And I think among the most important 10 or 15 minutes of TV in 2024 was David Tepper, who also has Alibaba as his #1 position in his portfolio. And he talked about breaking his position limits because he wanted to get even more if we get a pullback. And look, I could, let me put it this way. This has definitely been a great few weeks for sure. But I would also say, just as those of you who've been with me know that I was not despondent when it was at $59 and we were buying it hand over fist, and $65 and all of that. I'm not euphoric at $105. I think we're just getting started. So we'll push higher. We'll have a pullback to shake out all the hot money that doesn't believe in it and know what they own. And then we'll push even higher, and it'll be hated the whole way up. But listen in to David Tepper. This is, obviously I've been greatly influenced by Warren Buffett and Charlie Munger. And I'd say the third person that's been very important in how I think and how I've assembled my own framework and added my own inputs over the years has been David Tepper, legend. It's funny, I posted this on Twitter, and all the responses were from people saying, why would you trust him to pick stocks when he can't even pick a quarterback because he owns the Nashville Predators or one of the teams? And I literally just have no response to that. It's like, so listen in to the legend, the master, David Tepper here.
When we hear the Fed, okay, if they go 50, they may go more. We think, oh, mortgage rates in this country. Oh, we think business loans in this country we think interest on the net. You immediately thought China and currency differences around the world. So that was more important to you.
Because the undervaluation is, listen, you can look at your chart and look at a chart of Bob on your screen right there, whatever stock you like. In China, they are, even with the recent moves, they're like on a flat line low compared to where they have been in the past. And you're sitting there with single multiple PEs with double-digit growth rates for the big stocks that trade over here. That's kind of versus what, you're 20 plus on the S&P. Right. Okay, and then you have, so the question was China going to do the things that you want them to do? Okay, are they going to do the easing measures that you want them to do? So yeah, they came the other day, and what's his name, Pan Gongsheng, and I apologize because I can't even speak English well. He came out and he was like jovial. It's like, whoa, jovial, saying we're going to cut and we'll give you more. And he said we'll do more and more if needed. Now the Chinese to say we'll do more and more if needed, they don't say that because it's not been healthy to say those sort of things in China. But they said that the other night, and I've listened very carefully what government officials say. So I took it that they did a lot, they exceeded expectations, and they promised to do more and more and more. Okay? And that's very strange language, especially for any central banker, but especially over there. So that was the first thing that happened. And last night, we heard that they were going to have some kind of meeting, but they kind of blew away expectations on the physical stimulus, that they were going to do. Now, physical stimulus, if you look at your charts, if you like charts, because you used to be a broker, and that was a good way to do things fast, what can happen around the world when they do that? That's what you have to ask yourself now. So now you have the Fed. So just to backdrop again, the Fed's easing. You have a few more easings coming. The Japanese, they don't know what they want to do right now, but it doesn't matter what people think. They're going to be forced into things, and I can talk about that in a second. The Europeans are lowering rates, and now the Chinese are lowering rates. Okay, and they're aggressive in how they're going to do it, and they're also, believe this or not, swap facilities to buy stocks. Encouraging buyback of stocks, encouraging buybacks of stocks. Okay, this is China, all right? This is stock buybacks. Not only encouraging it, lending you money to do it. And they're giving money like TELF money, where you can put money out and you have no losses if you want to do it. You know how that thing works? You have only the money you put up, and you don't lose money. That's a great deal for me. I want to be over there and borrow for some of this stuff. So,
what about the relationship between the United States and China? How the Chinese government may or may not feel about American investors, but maybe more importantly, how the American government feels about U.S. investors investing in China too. What's the risk? How do you?
I mean, that would be a risk, and that's why you have limits on how much you would invest. However,
you just said you don't have those
the other thing I thought you were going to ask is about tariffs and stuff like that. I do not care.
Yeah.
This is internal stimulus. In the fiscal stimulus they did last night, they're going to encourage consumption, directly saying it. So they're really doing all the things that people have asked them to do over these years. So what will happen on world markets? So now you want to talk with the United States. Most of your viewers are here in the United States.
Or Europe or Japan.
Europe or Japan.
You started on Japan.
Okay, so we can go around the world. Obviously, this is incredibly good for very undervalued Chinese equities, okay? Especially when the government's encouraging
the buybacks.
Buybacks, and for you to take risks to buy stock.
Right.
Take a loan out, buy stock, you can't lose money on your loan. Great deal for me. I would, if you want to be Chinese, is Sorkin a Chinese name? No, okay, so sorry. Anyway, sorry. So you have, so United States, so you have this world, and so I'm trying to figure the United States, so it's not really your first plug to invest right now, because you would say China first, Asia second, right? Mm-hmm. Asia at large second.
Okay.
Japan, Korea, those markets. Also, actually, Asia and Europe before Japan, and I would tell you why. The problem with, you have to be careful a little bit about Japan, although I think it's still you want to be in the equity markets. If you look what happens, if China runs and they get the economy going and you get the animal spirits going, what happens? Chinese throw a lot of money in their economy. Who's one of the biggest beneficiaries in their own economy? Is Japan. And Japan, if they start running faster, I don't care what this election is, and they're worried about this candidate and that candidate. Some candidates might want to go to Abenomics, and I don't care. They don't even understand it yet. This just happened last night. The market doesn't understand it yet. What's going to happen? Japan's going to run too fast if they really stimulate there. And when Japan runs too fast, they're going to have to raise rates. And when they raise rates, the yen's going to appreciate. And if the yen appreciates, then you have to be careful about the stock market, not the stock, depending how it goes. Now, the stock market in yen terms, you should still make money, but how much does it move or not because of how it historically does, right? So you go around the world. The U.S., listen, the problem with the U.S., and then I could go European. The European index at 14 times multiple versus a 22, historically incredibly wide.
22 here.
21, 22, whatever you want to say for
14,
next year.
So Europe looks good.
Yeah, it looks interesting.
We're like last in Europe.
Well, Japan has the same sort of multiple right now, and you can say we have much better stocks and much bigger tech stocks and that. So the question here, where you don't have necessarily a cheap market, right? It's not a cheap market. It probably is, and I didn't listen to him. I listened a little bit, but what Cooperman said yesterday. But if you looked at it historically, it's a little overvalued. Okay, I would say that. However, I get concerned about one thing, because fortunately or unfortunately, I was around in the 90s. I was around in the 80s too, but I was around in the 90s. And in that market where the Fed, cut rates into Y2K, in a good economy, right. A relatively not a bad economy, but a relatively okay economy. You had those rich in before long-term credit, rich in 97, relatively rich, richer after long-term credit, and bubble mania in 99, early 2000. So I don't love. I'm a value guy. I don't love the U.S. markets on a value standpoint, but I sure as heck won't be short.
Well,
because I would be nervous as heck about the setup with easy money everywhere, a relatively good economy, and China just massive stimulus coming in. So it would make me nervous not to be somewhat long the U.S. Now, so that's how the setup is. So you can't be short the U.S. Right. You can't be short anything in Asia. Right. Anything in Asia. Nothing.
Okay. And we're back. And then on Friday, I had a chance to go on with David Lin on the David Lin Report. And these videos always go viral. I think it got like 65,000 views. You're going to find out why. It covers all of my thinking following the rate hike. So we'll listen in here.
How should investors be positioned in a Fed easing cycle? Which sectors have tended to outperform in the past? So what is coming up next? Thomas Hayes is here to break down his outlook. He is a managing member of Great Hill Capital and the author of a great finance newsletter called Hedge Fund Tips. Links down below. You should check out. Thomas was on the show a few months ago, back in July, and he told me, if it's indeed true that 2% is a fantasy even for the U.S., are you saying, Thomas, that the Fed is likely to cut before the core PCE gets down to 2%? I think it's at 2.6 now.
100%. I mean, nothing in life is 100%. I'd say 99%. I'd say if you take that bet 1,000 times, 999 times, you're going to be right. Maybe this will be the 1 in 1,000 where you're wrong, but I'd take that bet over and over.
He got that call right. So congratulations on yet another great call. You've been on a great streak all year. Welcome back, Tom.
Thank you so much, David. Grateful to be here.
So let's talk about what happened this week. So the Fed cut by 50 basis points. The market started rallying the day after, which was yesterday. On Friday, today, on the 20th, where stock markets are taking a bit of a breather from yesterday's rally. I was looking at stats, and let me just flip over to my screen here. I was looking at the historical performance of the S&P 500 in the past cycles when we had the Fed cut by 50 basis points. So here's the S&P 500. I'm going to overlay this with the Fed funds right here. The Fed cut in 2020, March 2020, by 50 basis points. That was here. And the S&P immediately fell shortly after. Well, that was because of the pandemic, of course. In 2008, it was a similar issue. Actually, the Fed cut right around here. By 50 basis points. And then that was during the financial crisis, right before the Lehman collapse. And then in 2001, same story. It was right at the cusp of the tech bubble bust at the time. And so the question remains whether or not we are in a similar precarious situation, which necessitates a 50 basis point cut, because in each of these scenarios in the past, we had basically a big decline in a subsequent 6 months after a 50 basis point cut. What's your outlook here?
Yeah, I think you could go back one more and take a look at 1995.
Yeah.
And then you could go back to 1982. So
Sure.
as you go back through history, and particularly that double dip there, recently for sure, it's had a negative impact. However, if you look at March of 2020, the market bottomed on March 23rd, and I happen to know that because we got quoted in March 22 saying we were in the market starting to buy stocks, and that was kind of put me on the map and put the podcast on the map and everything else that everyone said that saw that market watch, because everyone thought the world was ending, and we're like, no, let's take a look at some of these companies that are marked down, and that cut. You had one of the biggest rallies in the shortest amount of time, from April through the end of the year. Now. 2008, 2001, yes, those were bad situations. And I think that also goes for, if you look at the returns of the stock market following the first cut 50 or otherwise throughout history, those cuts where there was no recession in the first 12 months, versus when there was a recession in the first 12 months, the returns are completely different. And on balance, no recession, you're in the mid-teens up on the S&P in the first 12 months after the first cut. And those where you had the recession skewed overall returns down, because when you did have a recession, the returns were abysmal, despite the cut, like the two instances that you just pointed out. I think given where we are, GDP now at 3%, it hasn't been a perfect indicator or a predictor, but it's a barometer, let's put it that way. And earnings growth expected to be about 15% next year. It's very hard to get to a recession with that level of growth, and considering you need 2 consecutive quarters of negative GDP growth to define a recession. And I think what continues to fake people off, usually you get a recession once every 4 years. What's got everyone sideways and why none of their models and forecasting is working is that we've actually had 2 recessions in the last 4 years, both in 2020 and in 2022, when you had 2 consecutive quarters of negative GDP, which they didn't formally declare a recession because some accounting for the labor market was stronger at that point. But it is a negative technical recession. So effectively, if you pulled forward one recession that should have happened over an 8-year period, i.e. one every 4 years, and we've had 2 in 4 years, the runway looks pretty good. And the runway looks good particularly because the only thing that could have destroyed it was Powell screwing up, which he was close to doing. Everyone kind of knows in retrospect. Some of us were prospectively saying, but let's say in retrospect, that he should have cut over the summer when the Bank of Japan was hiking. And you basically had a liquidity mismatch. And I was really looking out for today with the Bank of Japan. I thought that was very important that the Fed cut 50 basis points, because while the Bank of Japan was expected to hold pat, which they ultimately did, if they had gone 25 and the Fed had only gone 25, I think you would have seen close to a repeat of what we saw in early August when the Nikkei crashed 25%. With 50 basis points from the Fed, if the Bank of Japan had done 25 is what I was very curious to see how the market would absorb that. The fact that they did 0 and held pat for the time being tells me that we kind of have some support here, despite the seasonal tendencies. Worst 2 weeks of September, pre-election weakness is historically the case since 1955. That may be overcome. I think, and I'll talk about how we've been thinking about it this week, but I think quite a few people are positioned for trouble before the election. And given the fact that the market is designed to fool most of the people most of the time, I'm coming to the view that maybe it's less trouble than most people expect. And the big surprise that would catch a lot of people off guard, if you look at option skew and other things where people are really expecting bad things, would be if the market actually moves higher into the election, which would go against all historical data and how people are positioned in their outlooks for the next 6 weeks.
Before we continue with the interview, I want to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below, or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. Wait, so when you say that people are positioned for more trouble, and I guess you mean more volatility up ahead before the election, are you saying that we have a net short position in futures right now?
Yeah, well, here's how I would look at it. So on Tuesday, going in with the same framework, that this would be, odds are, worst 2 weeks of the year are the last 2 weeks of September historically. In a presidential election year, you get a lot of volatility in September and a lot of volatility in September and a flush in late October before the election clears. we started looking for, okay, number one, could we harvest some cash to be able to buy the potential weakness in October? And there was nothing in the portfolio that we felt was exuberantly valued where we would want to get out of the position to raise cash. All the cash that we were going to raise, we did in July when some of the Mag 7 were just humming along, and late June when NVIDIA was doing their split and everyone loved it at 139. So not only could we not find enough good ideas to harvest cash because we didn't want to sell them at these levels, we don't think they're near fair value or fully valued, but we went through, a couple thousand stocks looking for ways to hedge the portfolio, i.e. put on shorts or index hedges. And the only fat pitch shorts that we were willing to put on that made sense from different things we were looking at in terms of fundamental analysis, in terms of technical analysis, they were all defensives, meaning everyone has crowded into defensives, consumer staples, utilities, ahead of the fall. So right now, you're so overweight defensives relative to discretionary. People are positioned for bad things. So the last thing you want to do is short defensives into a potential turbulent period. And the fact that so many people are already in defensives and positioned for a turbulent period tells me we may not get as much turbulence as people think. So I'm less looking at futures commitment of traders that I would normally look at, and that's a great go-to, and it's astute that you brought that up as the first thing to look at. But VIX is still a little bit elevated here, which tells me hedging premium is expensive. So, sometimes the worst case scenario for people that are high conviction on either the thing going down or going up is that the market grinds sideways into the election. That would probably cause the most pain to the most amount of people.
Actually, since you brought up, let's talk about sectors now before we get on to the central bank divergences, which you brought up earlier. So this is the S&P again in the bar chart. The purple line is the XLP, so Consumer Staples ETF. It's been underperforming all year still. So is that mostly just because of the tech outperformance, you think, Tom?
Well, tech weighting, but look at the hockey stick move. While from August through mid-September.
Yeah.
And this is what I'm talking about when I say people are positioning.
So over the last 3 months, it's just been on a tear. You're right. This is last 3 months here.
Yeah.
It's up 6%. S&P's up.
Go ahead.
Yeah, it's up 6%. S&P's only up 3%. So.
Yeah. So it's doubled the performance, and that's kind of how I'm thinking about. And if you actually go back to before the Fed cut, it was up 8 and change. Right? So just go back 2 days.
Oh, 2 days, yeah.
Yeah. You see that peak on the red thing? So it's up about
hang on, let me go back.
Oh, I see what you're doing.
A couple of days here.
Yeah, right there.
Right there, yeah. Yeah.
So it's up another 2%. So it's like up 8%. So everyone who is positioning for what is all known, which is the worst 2 months of the year on average, is late September. Presidential election year since 1955, tend to be really, really choppy and very big weakness into the end of October before the election clears and the thing rallies. So I didn't want to short defensives. I didn't want to short tech into the hole. So basically, we're just standing pat, fully invested, low to no leverage. And if we get weakness, we'll find some cash to buy stuff. And if the market powers higher, we'll take advantage, which could be a real surprise. If the market did push higher into the election, which I'm not betting on, but I'm not also, despite wanting to, not betting against, that would probably surprise a lot of people. And there's a tendency of the market to do that.
Why did you bring up the election several times as a turning point? I mean, what fundamental difference would there be for the markets if, let's say, we had a Harris versus a Trump win?
Zero, provided that we get a gridlock outcome. So if Harris were to win, it's probable that the Republicans control the Senate, in which case none of the market bad things can happen, i.e. taxing unrealized capital gains, which is the most ridiculous thing ever if you want an economy to flourish. I mean, you would destroy all incentive for people to invest in businesses. It's worrisome that someone would have advisors that would even broach such an idea, because it would be so devastating. And they're saying, well, it's only for $100 million people. You just don't, i.e. the people that create all the jobs would be disincentivized to grow companies, because you can't keep reinvesting if you're taxed before you realize the gain. It's mind-boggling. Leaving that aside,
sure.
And Trump's not full of good ideas either. Okay, he's got a lot of good ideas as far as business friendly, and I'm making no judgments about social friendlies or personalities or any of that. He's more pro-business. He's more anti-regulation. So in theory, the market should like that more. I will tell you that if the Republicans won the presidency, the Senate, and the House, that's not good historically for the stock market, no matter what people think. Just as if the Democrats won the presidency, the Senate, and the House is not good for the stock market. The best case scenario, whether Trump or Harris wins, is that the other party controls either the Senate or the House or both. And the name of the game is the market prefers if politicians can do very little. The less politicians can do, the better business will do, the better markets will do over time.
I spoke to somebody who is in the know on the unrealized capital gains proposal, which, by the way, Congress has not approved, or it probably unlikely going to approve. But according to our calculations, only about 10,000 individuals in the U.S. would be affected. Entities like hedge funds like yourselves would not. We're not going to tax unrealized gains from LLPs and BlackRock or any of that sort. So perhaps it's not that big a deal, even if it were to be implemented. But that aside, Harris
wait. Let me stop you there, because it's such an important, like, I can't overemphasize how bad an idea this is. Like, if I was going to write a book called How to Cause a Great Depression, chapter 1 would be entitled Start Taxing Unrealized Capital Gains. And you say it's only 10,000 people. How many public companies are there that matter? 2,000 that matter? 6,000 total? So let's just say the ones that really matter to people's 401ks, retirements, pensions are 500 companies. Let's just be simplistic. So those 10,000 people control a material amount of those 500 companies. And if they are forced liquidators with no ready buyers on the other side, because who would be the ready buyers? People who would also get hit by the unrealized capital gains and have no incentive to create that market liquidity. You're going to have hundreds of thousands to tens of millions of jobs destroyed, because you are old enough to have lived through what a dearth of liquidity looks like in the great financial crisis. That would be amateur hour compared to what would happen if this was ever implemented.
Well, let me just ask you, suppose it were to affect your fund. Suppose legislation were to be hypothetically implemented such that your fund would be taxed on an unrealized capital gains basis. Would you move offshore? Would you just leave the U.S.?
I'd probably retire and go play golf.
Okay. All right. Okay. That settles that.
Yeah.
This aside, though, so taking the unrealized capital gains discussion aside, Harris wants to raise top capital gains tax to 28%.
Okay, that I can live with. We've been to that movie before. We've been as high as 35%. In the short term, it would be bad for earnings. So the market would what was the word that Powell used the other day? Realign or what was the magic word he used? Realign or readjust or reconfigure. Anyway, we could deal with that. We've dealt with 35% capital gains. No bueno, but not a life ender. It would not destroy the economy. Taxing unrealized capital gains would unequivocally do that, even if it was limited to 10,000 people that control 80% of the stock.
Okay, so higher corporate taxes is okay, even though we may see lower margins and maybe slower spending, CapEx.
Yeah, bad idea, but tolerable.
All right. On the Trump side, I remember throughout 2016 to 2020, every time he announced new tariffs, the markets just threw a hissy fit. So yeah. I'm guessing capital markets don't like tariffs. Have things changed now that we're more adjusted? We've had 8 years of tariffs, basically, and sanctions.
another less than ideal solution for a complex problem. So let me be fair and criticize both sides, I guess is the answer. And by the way, both sides have some ideas that are sensible, and I don't want to make this a political talk. We're trying to keep it to markets. Tariffs, Trump is a pragmatist by nature, okay? So he's not an idealist. And the ideologues are the most dangerous type of politicians because they're making decisions on the basis of a zeal and a philosophy and a framework that may or may not be practical. Trump is kind of a deal maker. He'll put out these huge ideas and say, we're going to tax everyone 100%. And then when it comes down to it, he kind of plays the crazy card to get people to the table. And then he cuts a deal that he thinks is in the interest of the US people and creating jobs and putting America first, et cetera, et cetera. Is he perfect? No. Is it a practical way for a New York City real estate developer to go about implementing policy? Yeah, that's the framework that he used to build his business over time, and it worked on balance for him over many years. And I think it's an okay way. The market is used to taking people at their word. So when you say we're going to put 100% tariffs, it's like, wow, that would really be a bad idea too. Almost as bad as unrealized capital gains. So it does get worried. But I think after dealing for 4 years with Trump and knowing he puts out these grand claims and then he tries to get to a practical solution and more often than not does, I think they would take it with a grain of salt and let him work his process.
Are you looking forward to just the market stabilizing, if not rallying shortly after the election, just on the back of certainty for what we know? Basically, we know who's going to be president now. We know what the administration is going to look like. Some certainty is good.
Yeah, I think unequivocally, if we get gridlock and we have mixed government, not one party controlling all three branches, we get that rally. As far as the indices, though, when you have inflation in this 4 to 5% range, when you have rates in this range, 4 to 5%, et cetera, if you look at multiples over time, we're kind of in the sweet spot currently where multiples have actually averaged 22, 23 times. As rates go much lower, which implies growth may be slowing, demand for capital may be slowing, the multiple contracts, or as rates go much higher, which implies there's inflation and that type of thing, multiples contract. Like the 70s, you had single-digit multiples because you had high rates, which was fighting high inflation. But we're in the sweet spot where the market can actually sustain 21 to 23 times multiple, but we're kind of knocking up against that. So to your question, does the market rally after the election? I think a lot of companies rally after the election, but it may not be those 7 that are the most heavily weighted within the index. They'll do fine, but I think that trend that started in July that we've talked about on our past visits together persists. And all that means is margins are contracting because of the spend for the Mag 7 on AI and servers and all of that stuff. Their earnings growth has dropped from 50% down to the high teens, whereas the other unmagnificent 493 that had negative earnings growth not only turned positive earnings growth in the most recent quarter, but that accelerates up to mid-teens over the coming quarters. So a lot of companies that are still down and out are going to be doubles and triples, even if the indices have subdued returns that don't look like the rearview mirror of double digits. Maybe they look like high single digits, but monstrous amounts of money could be made in small caps. Monstrous amount of money could be made in value, which outperforms growth in the first 6 months. Small caps outperforms large cap by 11% in the first 12 months after the first cut. The 50 basis point cut really will help a lot of small cap companies refinance and raise capital and continue to grow earnings. So I think that is a long answer to a short question.
Yeah.
It's nuanced, indices up-ish nicely, but not bigly, I guess, dovetailing off our last segment.
Sure.
And under the surface, opportunities like we haven't seen since 2002 to 2007. Emerging markets.
Rally is going to be huge. Right?
Huge, but seen only under the surface. If you're just sitting in passive index funds, you're going to be like, oh, okay, it's okay. Things are going uppish, but it's not going to be boom. But if you're saying, look, this is what performs best after the first cut, I want some small cap exposure. I want some emerging market exposure. I want some value exposure. Those things that haven't worked for the last decade. If you're in those, you're going to be smiling so wide you could eat a banana sideways.
Okay, so to sum up, you like small caps for now. Not so sure about consumer staples, which we talked about earlier. Any sectors?
Speaking of consumer staples, if you look at the Bank of America Fund Manager Survey this week, the exposure to staples relative to discretionary is so stretched right now. So I think, and you saw it last night with the change of the CEO of Nike, for instance. Nike is an example of those discretionary stocks that are left for dead. Starbucks, in a lesser extent, left for dead, starting to get change. Lululemon, we don't own any of those three, which is why I'm telling you about those three. Lululemon, some of these companies that have been smashed because everyone's convinced the consumer's dead. The consumer's not dead. We've seen retail sales, and now they're over time. The interest rate environment is going to become more favorable. I also think we're going to start to see in the next 12 months, there is so much untapped home equity again. I think we could see the HELOC game turning back on. The consumer leverage is at historic lows. It just collapsed off the pre-Great Financial Crisis highs. There is so much room for credit expansion, and I think that's going to drive a multi-year expansion, at least into the next decade.
That means what for investors? We should be basically more cyclical in our positioning.
That is the framework that we're looking at, and I think a decent analog would be 2002 to 2007, where tech started to underperform. I don't think tech crashes like it did back then. I think it just underperforms relative to those groups that have performed less well. So I like cyclicals. I like discretionary. I like small caps. I like emerging markets. I like value over growth in the near term. And there's so many quality companies available that are marked down 50+% that are going to be doubles over the next 3 years.
But how do you feel about bonds in the last segment of our conversation? By the way, I'm looking over at, let's flip over to my screen one more time. This is the CME Fed Watch tool, and all the way to July 2025, the market's pricing in a significant probability of the Fed funds rate hovering anywhere between 275 to 350, which is considerably lower than what it is today. First of all, what do you feel about this projection or expectation, and how is it going to affect the bond market?
This is one that I think about a lot, David, and I think that those expecting the Fed funds rate to get to 3 quickly are going to be disappointed. I'm glad they did the front load because they were behind the curve. I think they were 200 basis points too restrictive. And I also think that the inflation numbers are going to be bumpy for the next. I mean, we are creatures of recency bias. I mean, I haven't looked at crude today, but whatever it is, hovering around 70. I think that's a temporary, not a permanent issue. I mean, you could wake up tomorrow and the Chinese government could announce a massive stimulus because they're behind the ball on their 5% target. And all of a sudden crude goes up 10% in 2 days because people start to expect greater demand. And then all of a sudden that energy in the input costs of all of the materials starts to go up, and people start to say, oh, maybe we're not going to 2.2%, maybe we're going to 3.4% inflation. And the Fed's not going to start to re-hike per se, but they're going to slow it down. So I think unless the labor market gets weaker in the next 2 prints, I think we're going to move to a regime of 25 basis point cuts from this point forward, and they're going to be spaced out. And it wouldn't shock me if the terminal rate is higher than 3%. Maybe it's 3.5. Maybe I wouldn't say 4, but I would say high 3s. And that's not bad news that's good news because it means soft landing was achieved and the labor market didn't blow up and we got the mid-cycle adjustment correct and we're reaccelerating. So that's what we're thinking about right now. That also supports all of the groups that I've talked to you about that we're interested in and invested in. So just as you've seen the Fed funds future go from expecting 7 cuts when we got none to now, to then expecting none and we got a 50 basis point and then now expecting this. I think it goes in extremes. I think the cuts will continue, but I think they'll be slower and smaller than the market thinks right now. And that is a positive thing for the economy and the market.
I'm going to flip over to the 10-year now, and I want to just take a look at how it's been behaving. This is the 10-year, and let's just chart it over inflation. So if you take, I think you know where I'm going with this. Over the last, what happened here? Okay, so over the last basically 40 years, there's been a relationship, and I want to call it a very close correlation, but a relationship between the 10-year and the inflation rates. Given your outlook on the macro, you just talked about the labor market and inflation stabilizing around 2.5% right now. What do you think is going to happen to the 10-year and ultimately bonds?
Okay, so we had been massive bond bulls for some time, and we've gotten a rally, and I think now we're going to get a counter trend move, i.e. our framework had been bonds up, yields down. That's worked, and that was a very unpopular view just a year ago, and that's been correct. Now that everyone is starting to say buy bonds, I think we're going to get a counter trend move. I think yields are going to go up in the short term. Not crazily. We're not going back to 5 or anything like that on the 10-year, but I think a 4 handle, it wouldn't shock me in coming months before we resume the downtrend in yields for some time. So,
by the way, do you expect corporates to do better now that we have a lower rates, lower chance of default?
Yes, because I think spreads are going to narrow as that window. Actually, high yield spreads blew out a hair in recent weeks. I think now that markets are getting comfortable that the window is reopening for companies, quote unquote, with distress, i.e. small cap companies to refinance, corporate bonds should do well. We don't really traffic in that area, so I don't want to make any calls on corporate bonds. But as far as the 10-year yield, our short-term view, which we don't trade on short-term view. We tend to hold our companies 2 to 4 to 5 years unless they perform way faster than would be expected, in which case, but that's a champagne problem. I think you get a counter trend move. I think you probably get a counter trend bounce on the dollar. The trend for the dollar is lower. Again, that was another thing that we were contrarian on. It's proven right. It's gotten weaker. Now that everyone's getting on board with that view, I think we get a contrarian short-term bounce, strengthen the dollar, and a short-term rise in yields. The antithesis of what everyone's expecting, when the Fed cuts, rates will go down. No, what the Fed actually did on Wednesday, and we said in our podcast on Tuesday, I said, I didn't think it was probable that they would cut 50%. But based on what I was looking at, I said it was plausible that they would. And on the basis of that, people would expect yields to go lower. They would go higher. And the reason they would go higher is because 50 basis points at this time dramatically increases the odds of a soft landing and a growth reacceleration, which favors cyclicals, which favors small caps, which favors value. And what I was looking at in terms of yields being compressed and staples and utilities, utilities are up 50% as a basket since last fall. And now everyone wants utilities. I said, there's going to be a counter trend move. Those were the only shoot in a barrel shorts, which we're not going to short defensives into a potential period of volatility. So how can the market cause the most pain to the most amount of people? That would be a counter trend move in yields, which means utilities would go down. bonds would go down, yields would go up. Why? Because now that utilities are up 50%, everyone's chasing them. No one wanted them 50% ago in the fall of last year. So I think that's the trend. And if that's the trend, it's hard to see a scenario where you have a monstrous drawdown in equities ahead of the election, even though the probabilities would favor weakness into the election. I think too many people are positioned for that, and the market doesn't reward when everyone's crowded into one trade. It tends to punish that. Particularly, it tends to punish the Johnny-come-latelys, and there have been a lot who would never be getting into utilities 3 months ago, all crowded in now that they're up 50%.
Final question, I'll let you go, Tom. On central bank divergence, which actually we started with, let's close off on that. So like you'd pointed out, central banks around the world kept rates unchanged this week. Would this pose a risk in the next coming months? Suppose we continue to get this divergence with the Fed cuts by 25 basis points, like you said, or even 50 in some extreme cases, but other central banks stay pat. Wouldn't that induce capital flows out of the U.S. into Japan or any other place that has relatively higher rates now?
That will be the trend over time. I think the trend over time meaning intermediate term, 12 to 24 months, is weaker dollar, bonds rally over time. I think the short-term counter trend is stronger dollar next few weeks, yields out next few weeks. But looking out a few months to more than a few months, you'll resume a downtrend in the dollar. You'll resume bid in bonds. That all favors the groups that we've discussed so far. And the stage is setting for the area that no one wants to touch, which is emerging markets. And we've been pounding the drum. But, sooner or later, these frameworks, they repeat themselves over and over and over, and the conditions are set. The table is set right now. That's going to be the next thing to surprise people, just as when you couldn't give away the 10-year some time back, and we were pounding the table on that has had a big, big rally for that instrument. And now that everyone wants it, you get the counter trend move.
Excellent. Where can we follow you, Tom?
I'm on Twitter at Hedge Fund Tips. We have a podcast called Hedge Fund Tips with Tom Hayes, which is well ranked in its the hedge fund category. It toggles between number 1 and number 3. And hedgefundtips.com is the blog.
Okay, we'll put the links down below. Yes, you've got a great podcast. People should check out Tom Hayes' newsletter and podcast. Great reading and great listening. So thanks for coming back on. Appreciate your updates. And you've been right all year. Let's see what happens in the next couple of months. You've got a few months left to be wrong. But
exactly. We got to keep our humility when you're on a run like that. So that's the name of the game. That's why we just try to stick to good companies at reasonable prices, and then we play the time arbitrage game, so we don't have to be right about all these zigs and zags. But right. I know you like the zigs and zags, so I'm grateful to be on and talk with you.
All right, well, we'll talk next time about some trades that maybe haven't worked out in your career. That could be a fun discussion. Thanks, Tom.
Maybe a long one, too. All right. Thanks, my friend.
And thank you for watching. Bye-bye. Yeah, thank you for watching.
And we're back. And then on Tuesday, literally an hour and a half before they announced the stimulus, you got to hear what I was saying to Sean Caleb's on CGTN America, basically on Chinese TV, telling the Chinese government, let's go, you got to stimulate. So I don't know if they heard it, but it is their channel. So they definitely acted pretty quickly on that.
Well, the Fed's decision to cut that benchmark interest rate has far-reaching consequences, not just in the United States, but across the globe. Worldwide, the Fed's decision to loosen its purse strings could encourage other economies to do the same thing. Reuters reports it has tracked about 9 emerging economies already cutting rates this cycle. However, experts say institutions such as the European Central Bank and the Bank of England will be more cautious with fewer plans for more cuts ahead. The Fed's rate will also have an impact on foreign exchange rates as the world's principal reserve currency, the U.S. dollar, has a huge impact on the cost of borrowing for emerging markets. Now, a weakened dollar could lift other currencies, with the yen and Swiss franc expected to see some relief through 2025. Now, for a deeper dive into all of this and how the Fed's decision is going to impact economies all over the world, let's bring in our friend Thomas Hayes. He's the founder, chairman, and managing member of Great Hill Capital, a long-short equity manager based in New York City. Thomas, great to have you back on. I find this pretty fascinating. Let's, broadly speaking, kind of walk us through how you see the Fed Reserve's rate cut influencing the global economy.
Well, Sean, thanks for having me on. I think the number one thing that happened with the 50 basis point cut and front-loading that cut to a large size is it took a hard landing off the table. What we saw as the immediate response as it relates to bonds was a buy the rumor, sell the news. So while everyone said, well, rates are going down now 50 basis points, why did yields go up in the last few trading sessions following that 50 basis point cut? And that's because a lot of it was priced in ahead of the cut. But I do think that is a counter-trend move higher in yields in the short term over the next couple of weeks, counter-trend move higher in the U.S. dollar short term over the next few weeks. But I think as you look at the intermediate term and the continued cuts and the continued reduction of restriction, you're going to see a weakening of the dollar. You're going to see rates come down, and that bodes extremely well for emerging markets equities.
Let's talk a bit more about the impact on these emerging markets, because emerging markets borrow money. And if the interest rate is going to be reduced, it seems it is going to ease the burden on nations borrowing these funds.
Yeah, there's no question. What you see in periods like this of easing cycle for the Fed is emerging market equities tend to outperform developed market equities. In the U.S., small caps tend to outperform large caps by 11% in the first 12 months. Value stocks outperform growth, and consumer discretionary comes back and outperforms consumer staples. We've seen a huge crowding into consumer staples and utilities, i.e. defensive stocks, ahead of the cut. And now that we have cut, the 50 basis point cut, I think it's reset growth expectations. If a hard landing is off the table, we could see higher than expected growth coming forward, and that shifts the type of stocks you want to be in.
Now let's think back to that Friday when the rate cut came, because the markets really didn't do much that day, but they have rallied in the coming days after that. So let's talk about the impact of the strength of the U.S. dollar and global trade balances. And I'm curious about the effect you think that the U.S. central bank cut is going to have on China, if any.
Well, historically, Chinese equities is a large weight in the emerging market equities index, and we believe that Chinese equities will start to outperform. It is going to need some help from the Chinese government itself in terms of a larger, more aggressive stimulus, but the table is set. If the Chinese government moves to stimulate, you are going to see a dramatic outperformance of Chinese equities over U.S. equities in the next 1 to 3 years. If they fail to do that and they start to miss their growth targets, it may be a more subdued response and a missed opportunity of a lifetime for the Chinese government and the Chinese people.
Interesting. Okay, how do interest rate cuts impact international capital flows, especially in sectors like real estate and technology? To a certain degree, as the global markets are pushing for the soft landing you've been talking about, nations tend to play follow the leader. Now, we know that the Eurozone and the Bank of England, they made cuts ahead of time. So the other nations, these emerging nations, they're going to be rising rates to curtail inflation to try to stimulate growth.
Money goes where it's treated best. So on balance, money is going to flow into those places that have higher yields. That's going to strengthen some of the emerging markets currencies. I also believe a lot of currencies relative to the U.S. dollar, whether it's the Canadian dollar, the British pound, the euro, emerging market currencies over time. And the big story that we have to keep our eye on is the yen, because while we've had about 85, 90 cuts around the world year to date, the Bank of Japan is looking to start to curb inflation, and they started with a hike in August. We saw the result of that in the first week of August, a big correction. Then they said, oh, we were just kidding. We're not going to do that so much anymore. Certainly not until the Fed got easy, which they just did. So I think before the end of the year, we could see more tightening by the Bank of Japan, which is a stronger yen against the dollar, and maybe more subdued response in Japanese equities than we've seen in recent years.
I like the just kidding. Okay, with inflation cooling down, do you think this rate cut is going to reignite inflationary pressures in other parts of the world? You talked a bit about what happened in Japan.
Japan is not affected. Their inflation is affected by many years of very easy policy by the Bank of Japan. So that won't be impacted as much by the U.S. policy. I do think that U.S. inflation should hover closer to a mean of 3% over the next few years versus a mean of 2%, i.e. the Fed target. And that's probably a good thing. When you have debt to GDP at 120%, historically, like we saw post-World War II, if you run inflation a little hotter than normal, it's easier to bring those debt to GDP ratios down than if you start to get closer to deflation, then the debt problem could be a bigger issue. So I think 3%, 3.5% is the sweet spot, and that's probably the base case for the next few years.
Quickly, Thomas, not a lot of time left here, but I'm curious if you think that the Fed waited too long to cut interest rates, because there was that concern if they cut 50 basis points, then they waited too long, and the markets were going to have an adverse reaction that first day when not a whole lot happened. I think people were tense.
They waited too long, and they're going to get away with it. So I'll leave it at that. I think that the front load was positive. We're going to see in the jobs report, not this Friday, but the Friday after, and then that will determine how quickly they have to catch up. Look, they were behind the curve on inflation, but they caught up. Let's hope that they can catch up in time, and I think they will, in fact, pull off the soft to no landing by moving as aggressively and as quickly as they did.
Well, I think a lot of investors are hoping you're exactly right. Thomas, thank you so much. We appreciate it.
Thank you, Sean.
Okay.
And then I had two hits after last week's podcast. One on Neil Cavuto. I want to thank Neil and Jenna D. Tomasis. That's Scott Martin, who was super excited that day. It was before the Fed cut, rather. You can listen into that on your own. That's just basically anticipating the cut, as well as CBS News. I was on also the day of it, talked about the implications of mortgages and consumers. So you can listen to that on your own. Want to thank Camille Smith for having me on CBS, and then want to thank the New York Post for including me in the article about Nike shoes. So on December 5th to 7th, I'll be speaking in Sarasota at the Money Show. You can click here to register for that event. If you're going to be down in Florida, take advantage. And our quote of the week is from Seth Klarman. The stock market is a story of cycles and of the human behavior that is responsible for overreactions in both directions. And, these are some of the quotes that got us through when everyone was flipping out, when BABA went down for no apparent reason because the fundamentals continued to perform and in most cases improve. And now we're just literally getting started. I got to tell you, the big joke of today is all the texts and emails and phone calls. Oh, wow, congratulations, blah, blah, blah. I'm like, on what? We're just getting started. They're like, should I sell some? Blah, blah, blah. And this is going to be the entire way up. You're going to see people buying the short-term tops and selling the short-term bottoms the whole way up because it won't be believed. Everyone will be skeptical and they'll miss the entire thing. Meanwhile, Tepper is saying, if we get a pullback, I want to go to 25%. I'm going to break all of my positioning rules and double it. So, just a difference of opinion. Moving right along to our data for the week. We've got a lot of it, and that's why we are prepared. Luck is when preparation meets opportunity, and that's what we try to do here and share with our awesome, amazing, treasured audience that you are. So here is some data from GIR talking about what happens after the first cut, and you can see on balance the returns are pretty solid, except when there's a recession. And The GDP just got revised up to 3%. The Atlanta GDP for Q2, Atlanta GDP is still hovering around 3%. Very hard to have a recession with 3% GDP, which knocks these two columns out, which means basically 100% positivity ratio without a recession. This is a S&P 500 after the NYSE McClellan Summation Index cycled from below 100 to above 1,000 instances within 2% of a 5-year high. And what you can see here is as you look out 2 weeks, 2 months, 6 months, and 12 months, the median and the mean are mid-teens, double digits. Manufacturing production for August month-on-month vehicles went up 17.3%, so that's a positive thing. S&P 500 after first decrease in Fed funds ratio after 5 or more increases, and you see the mean gain 12 months out, 13.4. So everyone, finagles the inputs and everything else. The bottom line is the cuts are a good thing, particularly when you're near new highs and you're not in or near a recession. Industrial production picked up. That's a positive thing. We've talked about PMIs in past weeks. You also see margin debt. This is from Seth Golden. Declined in August. So very hard to say it's a bubble or investors are exuberant. Now on the flip side, he also posted, so that's that. Asset class quilt of returns. That's from last week. We'll leave that. This shows stocks, bonds, T-bills, gold, and US dollar over time. As a reminder, you can't compete with stocks over the long term. 6.9% compounded, and that includes the 1800s, which were a complete disaster. If you take out the 1800s, it's more like 9 or 10%, including dividends, versus bonds at 3.5%. Mix of price and wage inflation bodes well for profit margins. That's from Goldman Sachs. So 15% earnings growth next year, margins increasing. Oh, and by the way, the albatross around the global economy's neck has been China's slowing growth, which just changed overnight when they announced fiscal stimulus in addition to the monetary. Wage growth has slowed, points to continued moderation. That's a good thing for inflation not ticking back up, but it will. It'll be about 3.5%, and that's a good thing, not a bad thing. Goldman Sachs economists expect roughly stable employment, so they're expecting this to go back down from their lips to God's ears, although as they've said historically, they are doing God's work, so they must know. Earnings estimates hanging in there at 278 for next year, which is about 15% earnings growth, 15.2. It's interesting, the chorus now is expectations are too high, therefore the market's too expensive. And that was the exact same chorus last October when everyone was selling in the hole that expectations were too high. And not only did they meet, but they exceeded expectations for this year as the Citigroup Economic Surprise Index is finally turning up, not down, which is what happens when the market goes up after you see stuff like that. 75 to 76 asset rally spurred by the Fed cutting from 9% to 4%. What outperformed? Small cap and value, which we covered with Brad and with Kristen this morning. Money market assets peaked 9 months after the first cut. But this was a jumbo cut, so it might be much faster, which means that 6 trillion or whatever it is right now is going to be coming out of money market funds and into equities. And that's why we've been talking not just this year and last year in 2022 when you couldn't give away stocks, and 2020 when you couldn't give away stocks. Go back and look at the tapes. We're buying hand over fist. But now you've got all of this dry powder that in coming months is going to come back into equities, even if you get a little short-term volatility. And that's a good thing, not a bad thing. Stocks on pace to diverge from historic September slump. And we're going to talk a little bit about that in the article of the week. Consensus projecting 18% EPS growth by year-end 2025. That's a big deal. U.S. new vehicle sales forecast for August got taken up year on year to 8%, and month on month over July of 12% growth. September was a little softer, so we're going to look at some estimates in just a little bit, but it is tracking to where we need it to track for Cooper Standard, which is a good thing and allows room for a positive upside surprise as rates come down, as incentives go up into year end to clear those EVs that aren't selling and replace them with hybrids, which are a money machine for Cooper Standard. Evidence of reshoring, more jobs coming, manufacturing, construction. You can look at the data. Manufacturing employment is finally ticking up after a two and a half year depression is what manufacturing has been in. Manufacturing construction spending is hockey sticking on the electrical and electronic areas, i.e. data centers, et cetera. So that's going to be a positive thing. U.S. semiconductor additions. These are facilities, Intel, the money from the government, Micron, Samsung, Taiwan Semiconductor, Texas Instruments, and you can see Arizona, New Mexico, Ohio. This is jobs, this is construction, this is manufacturing, this is Stanley Black & Decker tools. And what are they going to need? They're going to need backup systems from Generac. This is going to be incredible. Corporate commentary on reshoring. Everyone's talking about reshoring across corporate conference calls. It's through the roof. Construction pipeline for the U.S. data centers is rising. Stuff is old. CapEx is coming back. Manufacturing capacity starting to grow after 10 years of stagnation. CapEx as a percentage of operating cash flow just off historic lows. Infrastructure spend is finally ticking up. That IRA money is getting into the economy. And BIL project announcements focus on roads, bridges, and other major projects coming to a theater near you. Construction spend on U.S. highways and streets is $140 billion last year, keeps going up. 15% year-on-year inflation-adjusted growth. Employment growth is holding up for highway, street, and bridge construction. That's good. Value of construction put in place is growing. Value. So you can just see the story is very, very clear. Motor vehicles miles increased 10% since 2010, but the fatality rate is no longer declining. Okay, the key thing here is that you've got the average car on the road at 13.7 years, which is a record all-time high, and the amount of use per vehicle is going up every single year, not down, which means they're going to require more maintenance and more replacement. It's huge pent up. It was waiting for rates. It's coming to a theater near you, and it's going to be lower prices and lower financing costs all day long, coming from dealer incentives to clear the lots before the end of the year, and the production is going to ramp up. Global car production, you can see here the numbers ramping up. And this is also very interesting. A lot of the fiscal spend you can see here, but a lot of people very, very pessimistic. But when you look at the bull and bear indicator from Bank of America, it's not yet at an extreme, and which is why we keep seeing these atypical seasonal strength, and why 2 or 3 weeks ago when we got on here and we said, you know, we really want to hedge or be tactically short, but when we looked across 2,000 companies, the only thing we could find that we wanted to short were defensives, and you don't short defensives if you're looking for a market correction. So what it tells me is everyone already hedged out, and if you look at SKU and if you look at VIX, ahead of the Fed cut, and so probably the maximum pain trade the market's designed to fool most of the people most of the time is that we grind sideways through the election for the passive investors, the indices people, the Mag 7 people, burn through all that put premium, give them a goose egg for their efforts, or push higher. Those would be the two pain trades based on how people are positioned with their insurance, record levels of insurance, record cost of insurance to protect against downside, both a skew, particularly for 1 and 2 standard deviation events, and so on, which is why we remain fully invested, very low leverage. We'll ride any October bumps and play the year-end rally, provided we get gridlock. U.S. debasement, international outperformance, U.S. versus global equities. This game is over, ladies and gentlemen. I'm telling you, this is amazing. I mean, if you thought the extreme was in 2000, it pales in comparison to how extreme we are right now. That is changing now. China just decided that is changing. You are going to see emerging markets outperform developed markets, and it may very well be for the exact amount of time that they've underperformed, which is the last decade in a ZERP environment where Mag 7 outperformed. Now I think you're going to see emerging markets in a normalized rate environment with China stimulus and the demographics dramatically outperform, and this will revert back to the mean. Not to say the U.S. will crash; they'll just do a lot less well than what we're positioned to take advantage of. Okay, U.S. retail sales ticked up last month, sign of ongoing consumer resilience. Gas stations were weak. Retailers were strong. Health and personal care. Industrial production is up. That's good. Rebounds after hurricane-related drop. Manufacturing production, that's vehicles, we talked about, up 17%. Manufacturing production, you can see it visually here. Here's the Fed GDP now at 3%. Home builder confidence is coming off the death. It's like a phoenix rising from the ashes. As rates come down, that will come back, create more supply. Rates come down, more supply coming on the market for housing. U.S. on pace for more gas power capacity. That is good for U.S. gas power plants. That's going to be natural gas all day long. Jerry Jones and Great Hill Capital are going to benefit with Comstock Resources. All this is opinion, not advice. Click on terms at hedgefundtips.com. We don't know your financial situation. We deal exclusively with qualified clients, accredited investors, and institution/family offices. Prioritization of returning cash to shareholders at an 11-year high. This is concerning to me. And this is what I've always said. I'd rather buy companies like the Chinese who are buying their stock trading at 6 and 8 times earnings versus the Americans like Jensen Huang buying back $50 billion of stock at 42 times sales and dumping $750 million on the retail investor after they announce a split. It is what it is. All right, percent of debt, that's floating rate. Small caps 27.4. That's why small caps are going to outperform over the first 12 months. Refinancing window opens. That will help Cooper Standard in the first quarter refinance all of their debt, which will be another catalyst. Small cap forward PE relative to S&P 500. The last time it was this low was 2001. We continue to repeat 2002 to 2007. Good analog. Emerging markets, small caps outperform, value outperform. Value ETF flows are picking up this month. See, enough people are listening to my podcast these days. There you go. I'm joking. U.S. multifamily completions highest since 1974. That's probably going to be an area where you start to find your next batch of bargains in the next 6 to 18 months. Regional valuation, you can see where we are relative to the mean in the USA. Going back to the last 20 years, well on the top end. The world well on the top, well above the top end. Japan, mid. Europe, mid. Asia Pacific ex-Japan, mid. And emerging markets, mid. 11 times versus 21 times. You tell me, price is what you pay, value is what you get. Boeing's business is much more than just commercial planes. You can see here, $6 billion of their business, defense, space, and security is $6 billion, and global services is $5 billion. So there's a huge, diversified, amazing business. We've taken advantage of every day this strike goes on. We buy more stock. Thank you very much. I get to buy more share in a duopoly with a 10-year backlog of customers. Not a whole lot to think about there. They'll get it settled one way or another. U.S. stocks make up nearly 2/3 of the MSCI World Index. This is another sign of extreme, just like the Mag 7 weighting in the S&P 500. These will revert back to the mean, and we'll see that with outperformance of emerging and ex-U.S. versus U.S. in the next half to full decade. And no one's positioned for it other than Great Hill Capital and a few others that listen to the podcast, which we're very excited about them. Growth expectations remain weak, which makes me think that we can continue to climb the wall of worry. This is from the Fund Manager Survey. This is not what you see near euphoric tops. This is what you see near bottoms where you want to be a buyer, which makes no sense because we're a few percent from or near or at all-time highs, I think, today. Dollar probably get a counter trend bounce here before breaking lower, which will continue to help emerging markets and international, just like 2002 to 2007. Straight down, ladies and gentlemen. And I think we're going to have a similar regime in coming months and years. Philadelphia manufacturing was up. Bank of Japan kept interest rates steady, upgrades view on consumption. They will be hiking probably before the end of the year, probably after the election. So be alert to that. That will impact MAG 7. That will also impact Japanese equities, i.e. put pressure on both, which leads to flows back into where? China. Opinion follows trend, that all the skeptics will be forced into it. And it's interesting because, while BABA is up now almost 56 to 105, almost double off the bottom, and the move hasn't even started yet. And people will be chasing like nobody's business, and they'll get really excited when it's up 200% off the bottom, mark my words. Japan customer inflation picked up in August amid Bank of Japan rate hike view. Inflation means they're going to have to hike, so keep an eye on that carry trade. That's a story a few months out. The other thing that's interesting here, ex-recessions, the first Fed cut has marked the trough in the ISM manufacturing PMI. This is why small cap value cyclicals take off. City Economic Surprise Index turning up in a material way. There's a new biggest bull on Wall Street. BMO raises its year-end target to 6,100. That's Brian Belsky. Here, the CEOs can't buy enough stock at the top, and they couldn't sell enough stock at the bottom. You can't make this stuff up that you couldn't sell them a share when their stocks were down 50 and 75%, and now that they're up double, everyone wants to buy. This is bad policy, and that's one thing. I'm not going to say like I think China management is incredible or anything. I just think that they get it. I mean, you buy your stock, and you buy stocks generally quality when they're down, not when they're up. And National Association of Active Investment Managers, again, moving up, but not yet at extreme. Bull-bear spread is towards extreme, but it's a survey of 300 people, so, take it with a grain of salt. Average VIX during election year since 1992, it should climb through October. We'll see this year. Between the cut, the China stimulus, it's interesting what's going on, and everyone positioned short. The real pain would be a straight up, but I think more likely a grind sideways. In the US, to search is to Google. So mobile still have 95% share. Desktop is declining a little bit. That's from Statista. Next, half of bull market returns are made in the first 10% of the time. This is very important, and we've actually just seen an example in Alibaba. In 10% of the time, we've gotten basically a double off the bottom, 56 to 105. So, that's why we say we're patient, we're low leverage, and when it goes down, we buy more because we want to be positioned. When it turns, it runs away without you. And it's mind-boggling like how much stock we were able to buy in the hole is staggering. And it's funny, I was texting back and forth with a friend, and I said, I'm going to send Xi a Christmas card because he took so long to finally do the stimulus, probably a year longer than I expected. I bought so much effing stock in the hole down at lower levels than when I started that my basis is so much lower than where we are now, thanks to him dragging his feet. Otherwise, I wouldn't nearly have anywhere close to the size position we have. And so very grateful for that, despite the extra white hairs. There you go. So conditions are ripe for Chinese stocks relative to gold. So this is from Gavical, from my friend who sent this over. And it says China market has been here before, just before start of two bull markets. This is the Shanghai 180 total return relative to gold in RMB. And you can see when it gets down to these levels, you start secular bull markets. When's the last time it happened? 2013, and then you got to go all the way back to the early 2000s. Average job growth per month in thousands. Pre-COVID average was 177,000. We're at 174,000, so not yet in trouble. The other thing that they're showing here, the SOM rule may be incorrect, as the writer of the SOM rule said, and that is that prime age non-employment rate is going down, not up. The general employment rate is going up. So you can see this divergence here. And that's also in line with kind of what we said about immigration adjusted unemployment rate was estimated to be 3.6 versus 4.3 for the total inflation rate. Looks a lot like this divergence here. IT unemployment at new high, that's TechMag 7+, so keep that on your radar. UK retail sales turning up, so is ASOS, that tiny position. We were going to cover it this week, but with all the BABA news, we'll probably push that out to either next quarter or the coming weeks. That's a small position, but we're looking to maybe add more on this UK recovery. We do have a nice position in GXO to play the UK recovery, so we're in no extreme rush, and we made a lot of money on the Rolls-Royce recovery as well, for those of you who've been with us for a while. UK retail sales beat expectations during August sunny spell. So I guess the sun comes out and the Brits come out of the bar and spend money on stuff versus on Guinness, which is a good thing, not a bad thing. Earnings expectations for AI stock now lag the market. So when was everyone buying it? After earnings peaked and are now decelerating. S&P earnings are accelerating, core to our theme. DXY, which is the dollar index, doesn't typically rally during cutting cycles. Give this guy a raise. Captain Obvious. Autos benefit. And then biggest relative overweight in defensive versus cyclical since May of 2020. What did you want to buy in May of 2020 if you were listening? And what were we buying on the podcast? Cyclicals. We were buying banks. We were buying oil in the hole. And that made our 2020 one of the best years ever. This year has a shot. We'll see how this plays out, but it could be our best year ever. We'll find out in a few months. FMS risk appetite at 11-month low. Again, not things you see at tops, things you see closer to bottoms. This is the MAG 7 profits decelerating, rest of index accelerating. We continue to reemphasize that each week. Dividends likely to contribute more to total returns than during the last decade, which would be a big deal. Big change from the ZERP, which implies what? Implies international with more dividends does better than domestic as well. Increase in volatility from July through November in presidential election years, so we just keep our eye on it. Had a little volatility in August, obviously, with the carry trade, early September, and we'll probably get another scare in October. 12-month after first Fed cut, healthcare has highest hit rate, so that would be benefit us in terms of biotech, etc. China stimulus, a couple points. Well, we'll go through that on the article of the week. China reserve requirement ratio, so we know that came down 50 basis points. Repo rate, 20 basis points. The key was the stimulus. They're actually handing poor people $22 billion of checks. They've never really done that type of direct stimulus. They're following the Western playbook that worked so well during COVID. And they're issuing bonds for $280-something billion to start fiscal stimulus, which is a big, big deal. China equity exposure at 5-year lows, just in time to miss the first 100% off the bottom. Pretty exciting stuff. Dollar is weakening relative to the Chinese yuan. Remember, we wanted to see two things: yuan strengthen and Chinese bond yields start to go up. They are beginning nascent stages. That will accelerate now that the stimulus bazooka, not only monetary but fiscal and property, has come out this week. China hands out subsidies to car buyers, subsidize away, get the growth rate back. Alibaba is the toll taker for all of China, and we will benefit all day long. Fed officials leave door open to another large interest rate cut. We now expect a series of consecutive 25 basis point cuts through June of 2025. Market is now pricing 31 to 36 basis points of cuts for each of the next 4 meetings, which is from Goldman Sachs. Real personal consumption expenditure, PCE forecasts, are expected to go down. We're going to find out tomorrow. That's an important inflation number. So we got tomorrow that could shake things up either up or down based on the inflation number. I think my guess it probably comes close to in line. And then the jobs report next Friday is a big one to watch as well. Equal weight index starting to outperform. We covered that on one of the hits this morning. Cumulative record highs for the S&P 500 equal weight index. What does that mean? The unmagnificent 493 are doing what we said they would several months ago when we started pounding the table before the summer, is that Mag 7 would underperform, 493 would outperform. That's been happening in spades. More CapEx, more hyperscaler CapEx, that's going to destroy their margins and their earnings power. U.S. share buyback authorization, they keep buying up at the top, and that's predominantly the Mag 7, and they're going to get egg on their face for that. It's just a matter of time. This is from Brian Rich. This shows like a 7-year cycle up and down for the U.S. dollar. We just peaked 2 years ago, and this implies we've got another 5 or 6 years of weakening dollar, which is emerging markets and international stocks outperform. I love this. This is from Macro Charts. Shows that there's only been 3 other times that short interest got this high in China. They all began monster rallies in Chinese equities. Same thing is happening now. Chinese yuan hits its strongest level against the dollar in over 16 months as investors assess PBOC stimulus. All this stuff that we've said for months was going to play out has played out. Conviction, this was the second most crowded trade in the world, was short China equities in September, just behind long Mag 7, and just in time to get their faces ripped off. Based on S&P options, the next 2 NFP prints are the main catalyst until the election. So you can see here, major events are non-farm payrolls, CPI numbers, retail sales, non-farm payrolls, and then, of course, the election. Consumer confidence still low, another reason to climb the wall of worry, potentially. Worrying a little bit more about jobs. We talked about China. We talked about the yuan. Hang Seng, huge rolling returns. We'll cover that one in the article. Record utilities inflows. Remember last fall, pounding the table in October. No one wanted them, up 50%. Everyone wants them. Record flows into utilities in the last week. Sell, baby, sell. That's all I can tell you, which tells me we're probably going to get a counter trend bounce in yields on the 10-year going up, and that's actually started to happen, up 10 basis points since the Fed cut, which was pretty easy to anticipate, and we talked about it on the podcast. Global equity risk love has risen from the August plunge to high neutral levels, but is significantly below the extreme euphoria seen in July, which tells me there's potential room to run. Again, cross currents, nothing at extremes at present. Contrarians in China with the crowd elsewhere. Forward returns for MSC China when China risk love hits panic, which has been now. You've seen in cases like 1998, you get 54% ups in the next few months. 2005, a similar story, etc. So the only time you got negative was in the middle of recessions, which was the tech wreck, and in the 2008. Rest of the time, like 2009, up 48% the first 3 months. And then you look out a year later, the indices up 60+%, 100% in 2005, etc. The stimulus will go through, and then the Slumer, let's just take a quick look. Thanks to my buddy for sending that. And we'll just look at some of the big picture chart. You can see the 10-year yield. I'm waiting for a counter trend move here, maybe as high as 4%. I doubt it. It looks a little oversold. Maybe not. If you look at the daily, maybe it just holds this trend line, but just we've already kind of got the counter trend move that I talked about a couple of weeks ago, but we'll keep an eye on that. S&P breaking out of a cup and handle. Maybe it goes back and retests at 56.55, 56.51 before resuming the uptrend. Maybe it keeps going. We'll see. The pain trade seems like a grind sideways. Copper's recovering with China. Hang Seng broke out. Now it's testing that. I think it broke through that in the today. And equal weight industrials breaking out, materials breaking out, all the stuff that people didn't want. Here is from Cox Automotive. Now, remember we had that weak month when they had that computer software train wreck in June, and people took the SAR down from 15.7 or 15.8 down to 15.1. Now it's back up to 15.7, and that was updated yesterday. So that's like a conservative thing, if what I think can happen happens, maybe we wind up with 16. And remember, every 200,000 cars is like $3 of earnings once you get above like 15.8 for Cooper Standard. So you get $3 of earnings, you got a $30 to $50 stock. And, look, who knows what you got. But historically, they trade between a 10 to 20 times multiple when they're earning money. Chinese yuan, okay, we covered that. On to the next. China gives rare handouts to boost sentiment before long holiday. $22 billion set aside for financial direct assistance. They don't do that. They're doing that. Here's Jensen Huang selling $750 million, buying back stock to buy back his selling after jamming the retail person with tons of stock at the highs at 139 after the split. China's stock market rally may just be getting started. No kidding. This is, by the way, this is one of the best writers at Barron's, but up 100% in a handful of weeks. But he's right that it is getting started. A little late because like 3 days ago, all the articles were negative, but okay. Opinion follows trend. Chinese stocks extend gains after Beijing's stimulus bazooka, which we've been waiting for a long time. Latin America currencies drop on faded China optimism. Oh, yeah. So you had the first monetary stimulus on Tuesday. Then because it didn't go up 2 days in a row, the headlines got negative, and that was perfect setup for them to rip their face off today. What China's biggest stimulus since it means for investors? Okay, absolute positive rescue package set to trigger big China stock rally. That's from Wall Street banks. China cuts one-year policy rate by most ever in stimulus drive. China unleashes stimulus package to revive economy and markets. China's stimulus is a big deal, what it means for markets and stocks. So, opinion follows trend. China unveils biggest package yet to boost property market. Alibaba's Ding Talk launches new service bundled with AI features to boost productivity, AI-powered search. Starbucks, McDonald's, and other restaurants are ordering up CEOs. How it goes down with the stocks. By the way, PayPal is over $80. Remember pounding the table in the 50s and you couldn't give it away? That one was one that didn't take, that one took a while, and now it's just getting started as well. The Canada Goose, which we covered a couple of weeks ago, was up like 10 or 11% today because of China. And want to find something in the restaurant space because I like that they're replacing all these CEOs. A lot of these stocks have gotten cheap. No one wants consumer discretionary. I think that consumer discretionary is going to continue to start to rip against consumer staples. That's a new theme of ours. Alibaba Cloud unveils latest 2.5 large language model. CEO addresses the speed of AI development. Fed recalibration is a sign of confidence. And this shows rate cuts around the world. Canada's down 75. So you can see the divergence. Basically, everyone in the world is cutting. We've had like 90 cuts around the world. That's a lot of liquidity coming into markets. The only ones raising are Brazil and Japan. So, and Nigeria. So there you go. Small cap stocks post longest rally since 2021 after Fed cut. What's next? Nike has new CEO. 4 things to know. China weighs removing major home buy. Well, they did it already. PayPal stock rises on Amazon Prime checkout partnership. So now they're going to be on Amazon checkout after being on Amazon Aiden and Fiserv. So now they're doing a partnership with their Fastlane checkout, which is unbelievable. I mean, with Amazon, it just doesn't get any better. Maybe they should do a deal with Amazon, with Alibaba. PayPal, Amazon team up in first step of branded checkout collaboration. That's exciting news. China's yuan continues upward climb after Beijing stimulus rollout. PayPal expands services to allow merchants to buy and sell crypto. So there you go. I mean, they got their hands in every pot. This guy, Alex Chris, is rocking and rolling every which way from Sunday. Boeing union to resume pay talks as strike nears third week. strike away. You just let me buy more. Take the stock down to 130. We'll back up the truck. China homeowners cheer Beijing's move to cut mortgages rates by 0.5 point. China's Politburo supercharges stimulus with housing rate vows. Hedge funds snap up Chinese equities on stimulus optimism. They didn't snap it up on stimulus optimism. They snapped it up on short covering because they were all short in the whole second most crowded trade in history. So amen. The short covers are the first buyers, and then they'll be forced to be natural buyers over time. Singles Day preparation includes $5.7 billion to aid merchants, which means block out Pinduoduo and Temu. They've regained share. Now they're going to punch them in the gut and just leave them left for dead. China weighs 142 billion capital injection. This is all done. I'm just showing you what's going on here. Shore up in employment. So yeah, and I think the youth unemployment numbers that came out Monday or Tuesday might have been the final spark that lit the keg fire, because youth unemployment was at 18 and change, and they're like, no mas, we can't have these people rioting and have another Tiananmen Square. So they were proactive after dragging it out as long as humanly possible, again, giving us the opportunity to have twice as much stock at lower prices than we would have had if it wasn't for them dragging their feet. So Christmas card on the way. China's Politburo supercharges stimulus with housing rate. Okay. Intel strikes back. It has a great chip for the first time in years. That's from yesterday. And I'm thinking they're talking about the Gaudi, which we've been talking about for months. Yeah, it's related to their 18A chip manufacturing process, which is where the Gaudi is produced. They're also referring to Lunar Lake in this article. This is good stuff. I mean, Cowboys owner full of gas, stock market and sentiment results. So we went through these. Comstock Resources updates. Every week we like to cover 1 to 2 companies we own and or have discussed in previous podcasts, VideoCast. Today we're going to do Comcast. This is a natural gas overlaid with Comstock stock. And as you can see, like 2001 period, natural gas, or 2001 to 2002, natural gas was very low, spiked up, retested before a huge secular rally from 2002 to 2007 again. And the stock during that time went from looks like about $10 to $399 over the next 5 years. I don't know that it'll go that much. There's a lot more stock now. However, if you look at proved reserves, the market cap of the stock is about $3.2 billion. The enterprise value is about 5 or 6. The proved reserves are worth about the same as the enterprise value. The unproved reserves are worth another 3 times the market cap. So, basically you're paying for the proved reserves at $10 or $11 a share, and you're getting another $30 worth of value that's not accounted for in the price of the stock because it's not reported in the SEC PV10. So, I think on the conservative side over time, you probably have a $35, $40 stock over the next few years. And just as things overshoot on the downside in despondency, it'll probably overshoot on the upside in euphoria, which probably says 30, 50, 70 or more, and you got a $10 stock. So, and I got a good partner in this. Jerry Jones keeps buying stock day and night. He owns 71% of the equity. The risk here is that you buy it at 11 and he buys in all the stock or does a tender at 15 or 20, and you only make 50 or 100% in a year because he does an inside deal. But, I can live with that. All right, we covered SKU. You listened to those. Now, Alibaba update. All right, I didn't intend to do an update on Alibaba this week, as we just did a comprehensive one in August. You can see what we said in August at this link here, or go to hedgefundtips.com and type in the search bar Bobalicious stock market and sentiment results. Fiscal stimulus this week so far. Okay, we covered all that. They did the monetary easing, the mortgage cuts, the property down payments, the handouts, etc. Now, Baba's been trading between $65 to $80 most of the year, now up 50%. That's when it was $95 yesterday. Now it's $105 off the lows, and $95 and just getting started. With Xi now serious about stimulus to meet 5% GDP growth target, both monetary and fiscal, individual company fundamentals begin to matter again. Remember, we've been saying, look, we were buying it at 2014 prices. 10 years later, the only difference is revenues are now up 13x per share. Cash flow and earnings are up 6.5%. So revenues up 1,300%, earnings and cash flow up 650%, price is the same. That is a generational lifetime opportunity, and that even goes at $105 as much as it went for $80 and $60 a few weeks ago. You can see here how the business continued to grow despite the despondency, cash flow per share, earnings per share, revenues per share, return on capital, return on equity, and very interesting time for all these managers to get short China equities. Second most crowded traded, we covered this. China's stimulus may rekindle its positive impact on global M1. So money supply has been in the doldrums for them, and their stock market reflects it, down 80%. That's what happens when money supply contracts. And now it's starting to recover. And as that liquidity comes in, you're going to see monstrous multiples for individual companies. And that's how we're positioned. Now, two things to remember regarding Alibaba. Number one, most important part of this week's podcast, ladies and gentlemen, people will doubt and hate the rally all the way up. The recency bias around fake outs will have them buying short-term tops and selling short-term bottoms all the way up. What does that mean? They'll buy at 105, it'll pull back to 95, they'll sell 95, it'll shoot up to 120, they'll buy 120, it'll pull back to 110, they'll sell 110, it'll shoot up to 160, they'll buy 160, it'll pull back to 140, they'll sell 140, it'll go up to 200, they'll be buying till the cows come home, we'll start laying off some to them, it'll pull back to 150, go up to 220 plus, they'll buy that, and over and over and over. You watch, mark my words, this will be what happens. And that's that. When it becomes a consensus long, when Baba becomes a consensus long, opinion follows trend, and commentators are uniformly enthusiastic about China and Alibaba, we will lighten up. We are a long way from that. This is in its nascent stages, in my view. When you think about, quote, this time is different on every pullback, pull up this chart we posted in August and sit on your hands or go for a long, long walk. Opinion, not advice, see terms. Now, onto the shorter term market. Again, we're not yet at an extreme with fear and greed. We're getting closer. Same thing with National Association of Active Investment Managers. We are opening next. We are going to be opening soon for our Q3 opening. We've been closed since July for the smaller accounts, the 1 to 5 million, and the 5 to 10 can come in anytime. Open enrollment, bespoke service at their leisure. So we're excited to do that. We'll keep it open for a week or two. So if you're interested, you can get in queue. So you'll be the first callbacks when we go live early Q3. Earnings, exploration and production sector, top 30 weights in the last 60 days revised down 8.5% and 11%. So this may be skewed by one or two companies, but there will be some opportunity in this pile. But that's a downward revision. Industrials pretty much flat, down 21 basis points for next year. It's probably related to one company. So keeping an eye on all of that. And now, oh, very exciting. Podcast is over. Now we're going to shift to Ask Me Anything questions. If you don't want to stick around for Ask Me Anything, thank you for tuning in. We'll be back next week, same time, same place. If you would like to tune, oh, by the way, also, I'm going to be in Orange County Friday through Monday. If you are an existing or potential client, love to meet for coffee. That's about all the time I'll have. I want to spend the rest of the time with Caitlin and the girls, but happy to meet for 30 minutes. And I always enjoy meeting existing and potential clients. On to Ask Me Anything. First question. Lynn Porter, could you look at WGS, expected to grow 30% this year and 14% next? Earnings increase 85%. You ever buy companies where prices at or near highs, even if the earnings power shows great strength being in the forecast? Usually not. Gene D. This is a train wreck. I wouldn't touch this with a 10-foot pole. This looks like a promote. What is this called? WGS? Gene Doctor. This is one where you got to be Nostradamus and predict the future, what technologies are going to work. And I mean, yeah, they're still cash flow negative. They're working their way. Their revenues are bumpy because it's all a promote about they're going to get something approved and it's going to change the world. And sometimes it does, but 999 out of 1,000, it doesn't. Genomics related diagnostic. Now, I have no expertise and no edge here. They're in Stanford. I could go visit them, but not for me. I mean, they're going to just tell me that it's great and I know nothing about it and I'm going to take a pass. So, yeah, pass on that for me. Okay. Divas Lung asks, love your podcast. What's your opinion on Chegg? Market's betting they're going to go bankrupt. I don't like it, that textbook business. It used to be a great business. It might be a cigar butt and get one more puff out of it, but I think this thing was one of these Momo stocks that's just a train wreck. Not for me. Even if you get a dead cat bounce here, you could probably get a dead cat bounce to 10, but why? I'm not going to play that gamble. Tim D, thoughts on Celsius Holdings, stock down 70%. Revenues are expected to grow, international expansion on the way. I've been looking at this one, haven't done anything with it yet. They're mired in a lawsuit. I might be interested, but not yet. So leave it at that, and happy to miss it. Super happy to miss it. Darnell in Florida, can you look at Semler? They're buying Bitcoin with cash flow to put on balance sheet in place of buying back shares. Yeah, I'm just not even going to look at that. Humana, because I got to make bets on three things. I got to make a bet on management, I got to make a bet on Bitcoin, and I got to make a bet on whatever silly promote business that they're talking about, and I'm not interested. Humana, pretty beaten down. This is from Paul Falcone. Looking at it, very interesting. I think it's probably actionable. I'm not going to spend a lot of time going through it because I've briefly looked at it. So I would say definitely worth exploring and doing the work on, Paul. Alex Ward, love your show from the UK. Regularly stay up to 1 a.m. to listen. What are your thoughts on reverse merger of Kyve Brands in Innovation Group and Delta? No interest in that. I don't like reverse mergers, and I'm gonna pass. Next, Nate Kelsey, thoughts on Leslie? Yeah, this is the pool. I would probably go for Pool Corp. So these things were huge when everyone was buying pools. Now they've both gotten smacked. I think I'd wait for Pool Corp to show signs of turning around. Just do the higher quality one. Leslie's a promote. You could double or triple your money, but you could also go BK if they don't figure it out. Matt Mahler, GCT. Does being part of the Russell 2000 mean anything? No. Better than not being part of it, I guess. GCT's already been a 10-bagger and it's pulling off. Let me take a quick look. Giga Cloud Technology, I have no idea. Subscription, what do they do? End-to-end e-commerce solutions, a bunch of gobbledygook. I don't know what that means. Let's take a look at the financials. All right, so the free cash flow is turning up. Revenues are growing, so they must have done an acquisition because they have this big turn up. Balance sheet looks okay. Not my type of business, but probably worth. The fundamentals look okay, worth doing more work, but I'm pretty darn sure after I dig into it for an hour, it's going to be a no. I know that you're not a fan of Walgreens. Would you put CVS in the same boat? They have a little different business. I would just stay away from both. Life is hard enough. Just don't complicate life with stuff like that. Thoughts on Corning? That's from Brian David. GLW. Not yet. I looked at this one. Not for me. Move on. Jason says, do you think Intel would and should take the merger of Qualcomm? I would buy Qualcomm discreetly. So if they merge, I wouldn't lose sleep. I'd keep the stock. I don't think it's going to happen. I don't think they need them. I don't think they really need anyone other than the government spending them the money they've already committed, and they'll be fine. They're turning the corner, and this is when everyone's panicking, right when the 5 nodes in 4 years is done, and they got Lunar Lake, and they got 18A, and they've got Gaudi 3, and they got the whole thing. So now they just need to forget the European factories, do the U.S. factories, get the U.S. money, crank it out, and if you got to merge with them, great, do it. I like both stocks, so I'm perfectly fine with it. I don't think it'll happen, though. I think Gelsinger's worked too hard to get to where he is. I think he knows he's at the inflection point, and who needs it? If you had to pick one of your holding, it makes you most excited Christmas morning, think is a 5-bagger. Okay, so number one, the ones that have the highest upside potential have the most amount of risk. I would warn you guys on 2 things. Number one is getting too excited about one stock. We always have 8 to 12 companies, and we're running a very concentrated portfolio for very sophisticated, ultra-high net worth investors that can handle short-term volatility for long-term outsized rewards. So I'm not going to answer that, but if you've been listening long enough, you know which company we have a huge position in that has the most multiple upside. And the second thing is, now that everything's working all at once, everyone's going to get all excited. And the next company I talk about, they're going to put so much money in because they're getting in at the beginning versus after they've already doubled and tripled. And that's a huge mistake. You need, number one, to do your own work. Number two, talk to your own financial advisor or hire, someone if you're qualified. And 3, you need to be diversified and not all in, and do your own homework before you do anything. Because it's the winner's fallacy when you have a hot hand to then, think you're invincible and then the next one take double the risk. You have to have the discipline to constantly be diversified, constantly accept humility, and know that as long as your framework is sound, you don't control which one is going to double in 6 months and which one's going to take 6 years. Although, thank God they don't take that long, although sometimes it feels like it. But you won't know which ones happen faster than you expect and which ones take a little longer than you expect. But in aggregate, if your framework is sound, you can really do exceptionally well in the business. So with that, I'll leave it there. And I think, let me just make sure I'm not missing anyone's questions here. Elf, no thank you. Anyone else? No. Oh, Genpack, I like it. I've looked at it. I did nothing. It's kind of getting away from me. The only thing that worried me a little bit about it, I was looking at it in the low 30s. I didn't do anything. It's like a consulting business, so it's not as predictable as the businesses I like, but I did like it. I wouldn't buy it up here. If it pulls back down to the low 30s, I may take a look at this a spot in the portfolio, but I already own what I like. So, but nice find. I agree with you. Kyle, don't worry about the correlation to yuan and HSI. Just worry about the fundamentals of the business. And if you own a good business, you just sit on your hands and let it realize intrinsic value and then hit euphoria. And that's when you lay it off. Okay, I think we're done. With that said, we'll see you next week. Same time, same place. In the meantime, make it a great one. Bye for now.